Hello everyone, welcome to lesson 8 of Forex trading. This is what I would call a must-watch video. I hope at the end of this lesson you will understand the importance and value of risk management. In the previous lecture, we introduced to you market order, limit order, and stop order. Here, we will talk about how to perform risk management in Forex trading. In the financial world, we must accept that risk is associated with every single trade we make, no matter whether we are trading currencies, equities, options, or another instrument. Risk management is one of the essential things in trading. A good and proper risk management is a key to your success in Forex trading. Basically, there are three components in risk management. That is liquidity, odds of winning, and maximum loss per trade. The first one we want to discuss is liquidity. Liquidity is how easily you can buy or sell an underlying security without affecting its price. The lack of liquidity can cause several issues. This includes not being able to buy-sell a currency pair very fast, or not being able to buy-sell without affecting a currency pair's price. Basically, the lack of liquidity is always caused by the lack of a trading volume. Imagine that you want to open a position, but there is not enough trading volume in the market. So you may have to wait, and you may not be able to open this position immediately. Sometimes this also means you will need to get that position at an unfavorable price. Let's explain this in terms of an apple market. Imagine you go to a market and you want to buy 10 apples, but there are only 5 people supplying 5 apples in total at the moment, and each apple is worth $1. You can only buy 5 apples at this moment, and you have to wait for the new ones to come. Since the demand of apples is greater than the supply of apples, when the new apple come, the people can sell them at a greater price. So you will have to pay more for the extra 5 apples in the future. The good news is, liquidity is not a major problem in the Forex market. This is because the Forex market is so big that a trade can easily go through within seconds. Let's go back to the analogy of the apple market. Imagine a market full of people buying and selling apples. The volume is so high that you can easily buy-sell these commodities without affecting their price. However, if you have a large chunk of money to invest, or if you want to trade emerging market currencies that are traded at a relatively low volume per day, you may want to take into consideration of liquidity because it may affect you. The second important component of risk management is odds of winning. We must calculate the odds that your trade of being successful every time we enter a trade. For example, if your odds of winning is 80%, that is 8 out of 10 are wins or more, then you are doing a very good job. However, if your odds of winning is average at 30%, that is 3 out of 10 are wins, you probably will end up losing a lot of money. What we want to pursue in investment is at least a 50% odds of winning. So how do we increase our odds of winning? Basically, to increase your odds of winning, you must increase the accuracy of predicting how a currency pair moves. Generally, there are 2 types of analyses that could help you. The first is called the fundamental analysis, and the other is technical analysis. Some people use the first, some use the second, and some use both. No matter what methods you are using, your end goal is always to increase your odds of winning. Continuous learning and constant refinement of your knowledge in trading can never be overstated. Market Newbie is a good place for you to get good quality of learning material, market updates, and market alert. So do follow us. Let's go to fundamental analysis. Fundamental analysis studies economic growth, interest rates, and financial strength and the other aspect of a country in order to evaluate the country's currency. Traders will pay attention to news and reports that may affect the country's currency. Since details about fundamental analysis is beyond the scope of this lesson, we can talk about this in a future topic, or leave a comment and join our gold or diamond pack. Here is an example of how fundamental analysis could help with trading or predicting a currency pair movement. The US Federal Reserve has announced the increase of interest rate for a couple of times in a certain year. This might be a sign to long US dollar over other currency because the rising interest rate would attract more money to turn into the form of US dollar, which will make the US dollar appreciated. Fundamental analysis is more suitable for medium and long-term trading. This is because the market may not react to a certain policy immediately. The effect of a policy would need time in order for it to take effect. In order to see the currency pair moves towards the predicted direction, you will need to wait. Now, let's talk about technical analysis. Technical analysis is an analysis that uses the past market data in charts and technical indicators to help predict the price movement of a currency pair. There are three underlying assumptions of technical analysis. First is that market action discounts everything. Second, prices move in trends. And last and most importantly, history tends to repeat itself. There are many different forms of technical analysis. These include chart patterns and technical indicators. Here are some famous pattern-based theories, including Doe theory and Elliott wave principle. And here's are some popular technical indicators, including moving average, Bollinger Band, and moving average convergence divergence. If you want to learn more about these technical terms, technical analysis, and know how to utilize them, feel free to follow us on www.marketnewbie.com. You can also join our gold and diamond pack. Opposite to fundamental analyses, technical analyses are more suitable for short to medium-term trading. This is because signals from charts or indicators are reflected immediately when something happens. Another important component of risk management is managing maximum loss per trade. This is also known as stop loss. Different people will have different levels of risk tolerance. It is very hard, almost impossible to set a standard. But a rule of thumb is never risk more than 5% of your entire capital per trade. You may set the percentage lower than 5%, but do not go beyond. What this 5% means is that it gives you at least 20 times to invest before you lose your entire capital. This gives you confidence and safety because it is very unlikely that you will lose for 20 consecutive times. For beginners, we will recommend a maximum loss per trade of 2%. Let's take a look at an example. Let's say you have an account of $10,000. Then, the maximum loss per trade that you can take is $200. This is your stop loss. Let's assume that you're going to long or buy one standard lot of euro to US dollar at a price of 1.1500. Then the stop loss that you need is 1.1480 because For one standard lot, 1 pip equals $10. Therefore, $200 equals 20 pips. If you feel the room of 20 pips is too small, then you may trade on smaller lot size. In this example, you may trade 2 mini lots of euro to US dollar at price of 1.1500. Then the stop loss you set would be 1.1400. This is because for 2 mini lot, 1 pip equals to $2, and therefore $200 equals to 100 pips. A few take-home messages. The three major components of risk management are liquidity, odds of winning, and maximum loss per trade. Liquidity is generally not an issue in Forex trading. We want to pursue a winning chance of higher than 50% and never risk more than 5% of the entire capital for every trade. For newbies, we recommend to start with a 2% maximum loss per trade. Coming up next, we will discuss position management, another important aspect of Forex trading. Given the amount of materials that we cover in this video and the importance of risk management, don't be afraid to go back and re-watch this lesson. If you want to find more educational materials, visit www.marketnewbie.com. Also, follow us on Facebook and our Instagram channel. See you in the next lecture.